Okay, James, welcome to the podcast. It's a pleasure to host you. Obviously, we met a couple of weeks ago at the event. It was a pleasure to see you in person, so it's great to do this on the pod now. Could you just walk me through, first of all, and the audience, your background, because you have a wealth of experience all over the world, lots of different firms. Could you just walk us through, your experiences there?
Sure. I grew up in Singapore and out of curiosity wanted to know what all the little squiggles on the side of the lorries meant. So I went to university to study Chinese. I did Mandarin, Cantonese, and economics at School of Oriental and African Studies. And that took me out to Asia for my first job, which was a kind of general management role looking at investments into mainland China. That schooling took place in the early 1980s when China really was probably certainly ranked about 150 in the world in terms of GDP. It just was not on the world map. But I had the good fortune to experience really from the very beginning the kind of investment scene there, and in particular going into joint ventures for things like Cowgate baby food and Volvo trucks and various other things. That took me into the world of sugar because one of the projects we looked at was a sugar refinery in Guangdong province. And through there, I started trading physical sugar and futures and options related to that sugar. From there, I joined Man Group as a physical sugar trader, working in a refinery in Singapore. And then we built quite a significant refinery annex to a mill in North Queensland. And I ran Man's New Zealand office and Mackay Refined Sugars. And from that, I got into banking and the financing side of those very large products or projects, I should say, and the associated risk management. So when you're a bank lending money, you want to make sure that the volatility of the underlying commodity doesn't destroy the viability of the project. So that was really my introduction into the world of futures and options beyond just flat price risk management. It was really the whole kind of project finance side of things. From there, I spent time at UBS and then more recently, the last 12 years at JP Morgan, where I ran our global listed commodity business, speaking to the world's biggest real money managers, sovereign wealth funds, pension funds, of course, hedge funds, but also very large corporate clients and trade houses as well. And throughout the entirety of that sort of work in my career, it's always been looking at futures and options as a tool to manage risk. And one thing that I've noticed in this new role, perhaps we might discuss it in a little bit more detail, is just how little retail and individual investors think about derivatives as a risk management tool. I think everybody thinks about them as a leveraged speculative tool, but of course there's so much more.
Yeah, absolutely. And I mean, you're understating it. You were the man. All these different firms looking at your background, so it's super impressive. So, what kind of things did you experience at JP and UBS, etc., that made you want to found your own firm in AMT Futures and Options Desk? And maybe you can just explain to the audience the relationship between the two and some of the intricacies there.
Sure. So I actually set up my very first company when I left Man Group. So at Man Group, I was the head of white sugar sales, and I used to sell to a lot of industrial end users like Coca-Cola and PepsiCo, Cadbury, Kraft, these sort of people. And it really struck me how little they knew about derivatives and how to use them effectively. So I set up a company called Commodity Consultants Limited and spent a lot of time advising those very large corporations how to manage the price risk. And it was interesting. You'd go in and say, do you use futures and options to manage your price risk? And they would say, no, we never speculate. We're not allowed to. I said, well, hang on a minute. You're a very large soft drinks manufacturer. You're buying 8 million tons of sugar a year. If you haven't priced that, you're short. You have an enormous position. So how are you going to use futures and options, forwards pricing, to help mitigate that exposure that you have? Because, by the way, the entire market knows you're short until you're covered effectively. So then fast forward to the opportunity that came up here. And I had been for a short while at the London Metal Exchange as the Deputy Chief Executive of the clearinghouse there. And I was wondering about this whole retail space in financial derivatives. And the big thing I think that I saw running or being closely associated in the management of a clearinghouse was how little futures and options are understood, even really by our regulator, particularly at the retail level. So in 2008, we had this global financial crisis. And it was largely blamed on derivatives. But of course, derivatives is a huge catch-all phrase. It really encompasses anything derived from an underlier. So it might be mortgage-backed securities, it might be contracts for difference on various things, any kind of swap on any kind of asset or bundle of assets. And as a result of really I would say the Bank of International Settlements and all of the regulators that percolate down from that, was because these were all over the counter instruments, nobody really knew what the systemic risk was. So there was a big push to get even those over the counter products cleared centrally. It really led Warren Buffett to call them weapons of mass financial destruction, which was obviously, it sort of caught the zeitgeist of the moment, because literally there was so much systemic risk that people didn't understand. Now, the good thing is that when you put those things through a clearinghouse, they're all very transparent, very reportable, very easy to be able to see. And that transparency brings a much greater level of risk mitigation, because you can see where the things where the risk is piling up, if you like. And what struck me since 2008 is really the number of financial institutions in the UK that no longer allow their retail or high net worth individual clients to trade futures and options, because they think that they are weapons of mass financial destruction and or are too leveraged and or are too complicated for individuals to understand. Our view is that they are not too complicated at all. It just takes somebody to sit down with you and explain how you can use them. So if you look at the explosive growth of equity derivatives in the US, India, Brazil, China, certainly Israel, countries in the Middle East, they're very widely adopted. And yet in the UK and Europe, they're much, much less frequently done. And the reason why, as I said, is because the regulators want to kind of deter people from trading leverage instruments about which they have little knowledge. So we set out here to address what we see as a considerable gap. Now, the interesting thing is that at the end of this month, we have a thing called consumer duty coming in. And it basically takes puts the burden on financial services companies to make sure that their clients have a good outcome. So it used to be treat your clients fairly. It's now gone to ensure your clients have a good outcome. Now, how do you do that effectively? The best way is to talk to the person who's wanting to do the trade, to understand what their investment objectives are and how it is going to fit in with their overall, if you like, investment objective or trading strategy. And you can't do that if you're trading in milliseconds or microseconds on a platform. So in other words, you need to talk to a human being. So we set up OptionsDesk, which I hope combines, or the aim of it is to combine the best in technology in terms of digital marketing channels, digital outreach, the ability to be able to sort of see your positions and where your money is. But when it comes to actually trading these things, talk to us. Hence OptionsDesk. The product is a desk. OptionsDesk is just a trading name of AMT Futures, which in turn is a part of Amalgamated Metal Corporation, which is a very large £1 billion plus industrial metals processor. So that's kind of how it all ties together.
Yeah, that's brilliant. And just touching on that very famous quote from Warren Buffett, and I'm glad you've kind of unpacked that a little bit, and you're leading with that risk management element. If someone's listening to this and they're saying, okay, yeah, that all makes sense, but they've never traded options before, what do you think are some of the most common misconceptions or myths that put people off trading them? Is it that kind of lack of transparency? Is it that leverage kind of like association? What are some of the things that, in your mind are preventing people from actually taking that plunge?
It is a great question, and it goes to the absolute heart of everything that we're trying to do here. So I once went to a conference where a very large retail fund manager was present, and I asked him point blank, "Do you use options and futures to manage the price risk of your portfolios?" And he said, "No, far too complicated." And I said, "Well, when you say complicated, what do you mean exactly?" And he said, "Well, what's the price of an Apple option?" And I said those fatal words, "It depends." And he said, "Exactly. Of course it depends. Is it a call option or a put option? Is it in the money, at the money, or out the money? Is it for a short duration of 2 to 3 months, or is it for a longer duration of a year or two?" So the minute you say it depends, it becomes non-binary. So I think the biggest single thing is to just explain why these products are so powerful and exactly what they can be used for. And when you see things in context, I think it makes them much easier to understand. So if somebody is thinking, "I'm going to trade an option," the kind of question is, well, where do I even start? And to that end, we've actually put a thing on our OptionsDesk.com website called a Strategy Explorer. And in that Strategy Explorer, you basically enter, you don't enter any personal information whatsoever, not even an email address. It's completely free for anybody to use. But you basically put in there, how experienced are you in terms of investing generally? Have you ever traded options before? Kind of binary, yes or no. Are you bullish or bearish? What do you want to use these options for? And is it to protect your existing store of wealth? Is it to generate some additional income from your portfolio? Or is it to trade tactically, perhaps either around your current holding or on a particular event? And then we ask about your attitude to risk. Is it defined risk? I do not want to lose more than X. Or do you have a higher risk appetite? And when you filled in those, it'll say, here are the options products that you could use given those range of scenarios that you have answered. And then on each of those, whether it's buy a call or a call spread, a put or a put spread, or anything slightly more complicated, it'll give you a breakdown with a payout diagram of exactly what each one of those trades looks like. But I think, Eddie, where it really starts is, what are you trying to achieve? If it's a straight directional punt, that's one thing. If it is, I have quite a big portfolio, I'm very, very worried that the next move could be, into a bear market, and I want to buy some protection, just like I would insure my car, then that's something. If it's, I have a whole load of stock, which I'm quite happy to give up if it goes, say, 10% up in the next 3 months, would I happily sell some of that? Absolutely. In which case, maybe grant some calls, take the income that you can get from granting those calls. If the stock does go up 10% in 3 months, you're going to deliver some of that stock. If not, you're going to keep the $3 or $4 premium that you just got when you granted those options. So things like that. And then on the tactical trading side of things, I think that there is going to be a big move in reaction to a particular event. And it might be signing Brexit. It might be something as small as non-farm payroll or a company's set of quarterly results. But I think, consensus says this, I'm above or below or in line with, and how would I trade that? So I think when you start to understand what it is that you're trying to do, then understanding options becomes so much more simple in that context.
Yeah, there's a lot to unpack there. And to really drive this, point of education home, I think it'd be really useful for the listeners just for you to unpack, some of those terms that you just, were talking to. So you talked about calls, you talked about puts. There's much more complicated option strategies that, again, butterfly, straddles, strangles, all of this stuff that people may have heard of that probably have put people off. Could you just, using a very simple example, could you just explain a call option and a put option? And I'm aware that you've got this really exciting partnership with the CME Group. So maybe you could use gold as an example just to illustrate if someone was looking, at, I believe gold's going to go up. Why would I buy a call option on that gold instead of the underlying commodity?
Sure. Okay, well, let's say that gold is currently trading on the CME at, I think it's about $1,926, give or take, 1926 roughly today. So I could go into any physical gold shop and buy an ounce of gold for about 1,900 US dollars, give or take. If I'm buying coins, there's probably might be a $30 or $40 premium on that, but in the ballpark. If I was to buy a COMEX gold future, there are 100 troy ounces to a futures contract. So that would cost me $192,600 worth of gold, would cost me roughly, in terms of the margin I have to deposit day one, approximately 10. It's typically between 8 and 12%, but call it 10% for easy maths. So I would have to put down a margin of about $19,260 the day after I traded that. And that covers my worst probable one-day loss. And then every day thereafter, I mark that position to market. So if it goes higher up, that's great. Nobody's going to call me. But if it goes down, I'm going to have to top up to make sure that I always have that 10% buffer, if you like, that's going to cover the worst probable one-day loss. That's on a futures contract. If I wanted to buy an option on that gold, then I could buy an at the money, let's say 3-month call. So at the money means in roughly where it is. So an at the money call in 3 months is $1,955, so $1,955. And for that, I'm going to pay a premium of approximately $3,300, something around that level. Now, the cool thing about buying a call option, or buying any option for that matter, is the most amount of money I can possibly lose is the premium that I pay. Obviously, plus any brokerage commission, but basically the premium that I pay. So I now have an economic interest in $192,000 worth of gold that I can take up if I want to in September by exercising my right but not my obligation to take up that gold. Now, if that gold moves in my favor, you can calculate roughly what the leverage is. And without getting too complicated, an at the money option has a delta of 50. So for every dollar the price goes up, the option goes up by 50 cents. So obviously, the more in the money it is, the more the delta increases in your favor. But really, what I've done now is got long of gold at the sort of current level that I can exercise anytime between now and 3 months from now for a absolutely finite sum that I can lose. Now, the really good thing is that put options also are a bought option, which means I can never lose more than the premium that I pay. But the great thing is it allows me to go short just exactly as easy as it allows me to go long. So if I think the price is going to come down, then I can buy a put option very, very simply using exactly the same logic as the call option. And you're not having to go short naked of anything. So clearly, if you short a CFD or if you short a future, there's every likelihood every day you're going to get a margin call that, well, you will get a margin call if it moves against you. Whereas with an option, once you've bought that option, that's it. No margin calls, no nothing. And obviously what you need to do is make a big enough profit on that option to cover the cost of buying it in the first place, i.e. the premium that you paid in the commission. But once it's in the money, you can just let it run and run and run. And that delta gets closer and closer to 1. So it starts moving in sync. $1 on the gold price, same as $1 on your option. It's basically a delta 1 product.
Yeah. So it's the option, but not the obligation to buy an underlying asset at some time in the future. And you can take a bet that you think, let's say gold is going to go up by buying a call option. If you think it's going to go down, you could buy a put option. You can only basically lose the premium. So let's say if you were just to buy it outright, you could lose, the whole, basically it could go to zero. So if you want to express a view, it can be maybe a more cost-effective way of using your capital and expressing a view. Is that fair?
Eddie, you have literally written the textbook in that answer. That is exactly right.
Takes me back all the way to my derivatives classes at university. So that's kind of trading, let's say, a commodity. You can obviously do it on equities and stocks for some of our listeners. But there's also a really key point in the sense of portfolio protection, right? So if I'm listening to this, I'm a retail investor, maybe I've got a portfolio of stocks, maybe they've done really well. I've seen Nvidia, Tesla, all these AI stocks go to the moon over the last 6 months on this AI frenzy. And I'm thinking, do I want to chase this at these valuations? There's a lot of economic risks on the horizon. Maybe I could use options as a way of some sort of portfolio protection. Could you just walk us through, in that example or another example, of how we can use options to not only trade, let's say, single names, which is, I guess, what options are almost associated with, but really over a longer term strategy or a portfolio protection angle? Could you just walk us through how one would do that?
Sure. So let's say that I have in my advanced years a nice little portfolio of equities, maybe some bonds, maybe some other things in there as well, maybe some real estate. And I build up a nice little nest egg. And what I don't want to do is for that nest egg to be diminished in any way. So if I think that we are going into a bear market, if I think that there is a lag on interest rates such that company profits are really not going to be effective for the first 18 months of that interest rate hike cycle. But then, oh my goodness, the cost of capital goes up really quite significantly. The return on investment comes commensurately down quite significantly. And suddenly the P&L of those companies that I hold shares in is looking a lot shakier. So if the next move, and bear in mind in 2008 global financial crisis, the markets fell 37%. That is massive wealth destruction. And the question I'm asking myself now is, will the world's central banks be able to print even more money to bail us out the next time that this happens? Or are they going to actually have to let things go a little bit here and let investors take some pain, which I suspect is what's going to happen. So if then I'm worried about markets coming down, but I really want to keep hold of the portfolio of shares that I built because I believe in the companies in the long term, what can I do about it? Well, you can basically rotate a little bit from equities to bonds, from value to growth, or vice versa. You can sort of move around geographically, sector specific. But the reality is that in a global financial crisis, all of these assets that are meant to be negatively correlated or just uncorrelated suddenly become completely correlated. So one thing that you saw in 2008 was your Bloomberg screen was either all red or all green, because everything was basically risk on or risk off. So if I think that something scary like that could happen, would I be happy to pay a small amount of money for some insurance? A little bit like my car. I might be quite happy to pay £300 or dollars to insure my car. If I don't crash it, happy days, that's $300 down the drain. But if I do crash it, I've now got £25,000 worth or dollars worth of repairs, and I'm back on the road. So in terms of protection, we think about it a little bit like that. And the alternative, which is what people do now, is when they get bearish, they move some money into cash. The problem with moving money into cash in the current interest rate environment is you are locking in nominal terms, real terms, a loss, because basically your money is depreciating quicker than the assets that you could be buying with it. Your purchasing power is diminishing. So in that instance, you're moving into cash. That cash is going to buy you less in a year's time than it does now. Notwithstanding the interest rates going up, inflation is going up quicker. that's the gap. So then I can basically also, if I sell my stocks and move into cash, I'm going to crystallize any capital gain that I have outside of any tax wrapper, like a pension or an ISA or whatever. And the other thing I'm going to do is forego any dividend income that I would have had I held on to those stocks. And the worst thing of all is that now I'm in cash. Pretty much guarantee you as a retail investor, I will lose money because I will miss the bounce. People tend to sell low and buy high, the opposite, obviously, of in an ideal world, what you would do. And that gets to be a real problem. That's probably the thing that damages your portfolio the most by moving into cash. So the alternative is buy a put option, which will give you a magnified, leveraged payout in the event that the market goes down. So in terms for buying a £10,000 worth of put options, I might have a payout in the event of a market crash of maybe £150,000 or more, £200,000, depending on the leverage I employ. So for a small amount of cash outlay, I can get a very significant amount of portfolio protection, and I don't mind if I write that premium off. So that's when we start talking about using put options to protect your existing store of wealth.
Yeah, I think that's a brilliant explanation, and I think the key message there is, I think retail investors are fully aware that they should stay invested during any volatility, because over the long run, chances are markets go up. So this is a great way of staying invested and having some insurance. Insurance on a portfolio is the perfect way of explaining it. And actually, if you look back at the start of the year when all the Wall Street outlooks came out and they were very bearish on the markets and the economy, many sold, many people did sell because of this bearish outlook, yet markets have obviously ripped higher. If they had been using options, they would have been able to stay invested. And in the, if markets had fallen or any assets had fallen, then they would have been protected, with a bit of insurance. So
exactly, you have an insurance policy and you sleep like a baby at night.
Yeah, everyone loves to, sleep with a bit of, bit of confidence and calm. So, if you want to sleep better at night, then might be a good.
And Eddie, the point you make is a very important one. It really is. Options, in a way, a kind of safety release valve. You've got this pressure, you're feeling really nervous, you think the markets are going to go down, but they might not, don't really know. It's just a kind of just a pressure release valve where you can just let a bit of air out of the tire, but stay fully invested. And that is, as you say, the long-term goal of every investor should be to be fully invested.
Right. And it's really useful in this context now because it's almost the perfect time to be speaking about this, because markets have roared in the first half of the year. We're now in the, just starting the third quarter. How are investors using options now on the institutional side or the retail side? We're seeing a little bit of lots of volume on call options, because they've missed out potentially on this tech rally, but they don't want to then jump in and start chasing this up with all this kind of economic weakness to come. So what are some of your observations, just like where we are right now in the market and economic cycle, and how you're seeing retail or institutional using options and the benefits of that?
So Eddie, you will be very familiar, I suspect many of your subscribers will be too, with a thing called the VIX volatility index, traded in Chicago. And that's widely known as the fear index. And that gives you a kind of very good gauge of how volatile stocks are and how risky being invested is. And what's interesting is that we have had a really 24%, 25%, call it, appreciation in the S&P 500 over the first half of the year. At the same time that we have some terrible things going on, in Eastern Europe and a lot of potential risk there. So one of the things that the Fed has had to try and do is land that economy on a sixpence. Incredibly hard for it to do, but at the moment it's really looking like it might have pulled it off. So obviously this quantitative tightening and the increase in interest rates has taken some air out of the economy, some steam out of the velocity of money, and inflation is kind of coming back in the US under control. So huge questions around whether the pause in June is the end, or literally just a pause with maybe a terminal rate of say 5.5, 5.75%. Traders, by and large, are naturally optimistic people. So unless they're told otherwise, they're basically going to think Fed pause equals good news. On the flip side, you have, as I said, war and the cost of war on things like shipping and oil and various components that go into make up inflation, which can obviously be a massive drag on company earnings. But also stagflation is like the worst of all economic environments, where you have high inflation and no global growth. And that's a large part to do with the potential decoupling of the world's economy, the friction, if you like, between the US and China obviously being the main component of that. So to answer your question, when the VIX is trading at around 13 and a half, where it is currently, the fear index is really saying there's not a lot to be fearful about. Now, when volatility is low, Vega is a large component of the price of an option. The volatility is a large component of the price of an option. When volatility is very low, the option is relatively cheap. So now is a good time to be buying options. And to answer your question about what are investors and institutions doing now, they are buying, I would say, options, calls and puts, and even straddles and strangles. So if you think that the market is going to do something quite big one way or the other, let's say that we're in the foothills of a bull market. The Fed has landed the economy on a sixpence. The rest of the S&P 500 is going to catch up with the seven constituents that have driven all of that growth pretty much in the first half. China is going to re-emerge on the world stage. It seems to be slightly normalizing or getting back to a pragmatic relationship with the United States. And you think that interest rates globally are going to start coming down, consumers are going to start spending, particularly in China, then happy days. With the next 20% move could be up. However, if something terrible were to happen during this conflict in sort of Eastern Europe, and were, for instance, a nuclear power station to be hit by some strange ordnance, things could go bad very, very quickly. And the next 20% move could just as easily be down. If you thought it's really going to move one way or the other, but I don't know which way, then actually buying calls and puts could be a really good way of taking an each way bet. So you can either sort of bet that things are going to go up, buy some call options, bet things are going to go down, buy some put options, or bet that things might go either way, so I'm going to buy both. And that is when you start looking at how you can layer option strategies one on top of the other to come up with a very bespoke sort of package of what you think is going to happen. And it's worth also remembering what an important component time, or theta as we call it, is in the price of an option as well. So obviously the flat price underlier, the volatility in the market, and the amount of time that you think it will take for your particular view to express itself. And that all goes into probably at this point in time favoring a long option strategy, and call options in particular.
Perfect. We're even touching on the Greeks here, so this is a real masterclass in options. So I think this is also a great place to potentially end it, although we could probably speak for hours. Where can people learn more about options if they're listening to this episode? They think, okay, this makes a lot of sense. I've had some misconceptions demystified. I thought it was just all about YOLOing into meme stocks, call options, and buying Tesla calls. But now, okay, James has come. He's talked about insurance, that allows me to sleep better at night. That makes a lot of sense. Where can they learn more and also actually action this, or maybe get a little bit of care in terms of, the options desk, in terms of actually speaking to someone, maybe them coming to you and saying, okay, I've got this view and I also think this is going to happen, but I'm not quite sure how to express this in an actual option strategy. Where can people, learn more and actually start to action this?
Well, first of all, I would say that the global exchanges have really fantastic product information and an awful lot of information for investors about their products and how to use them. The CME Group in particular has a very, very good part of its website. So just have a look there and Google CME Group for an explanation about options. But at the risk of blowing our own trumpet, then we have www.optionsdesk.com. And in there, you'll see there is a very large resources center where we talk about every single one of these option strategies, from the absolute basics of buying a put and buying a call through to the more complex strategies as you layer perhaps one on top of the other on top of the other. And you can obviously grant options to fund the purchase of an option to reduce the price, but reduce the payout. And what you'll find on that site is that every one of those options uses the same XYZ corporation, which basically tells you what the cash price of the equity is. And for all of the different option strategies, the P&L of each of them in the event of a market move in either direction. So we've tried to make it as clear as possible. And then we have a number of news and insights pages where you can look at real world examples of what you could do. Now, it's worth saying that we don't give our clients advice. We think that the value is talking to our clients about what their investment objectives are and how they could express them. So if you think that so-and-so is going to happen, what could you do to position yourself accordingly, or to profit from, take advantage of, protect yourself from what you anticipate may happen? So that's how we try to do it. We are very happy to talk to anybody who wants to talk about these strategies. And we would just say that they're very easy to trade on digital or electronic platforms. It's very easy to lose a lot of money very quickly. And it may be the best investment that you ever make is just talk to an expert about what your objectives are and how best to achieve them.
Yeah, that's brilliant and great advice. James, it's been an absolute pleasure, and I hope to see you in person again soon. But thank you so much for joining me.
Eddie, thank you very much for inviting us. Really enjoyed it, and I look forward to seeing you soon.